Hello, thank you for joining us for this week's Market Carver. I'm Andrew Thrasher, Portfolio Manager for Financial Enhancement Group. I'm joined by Zach, Senior Investment Analyst, and we're going to cover two big topics for you this week, a little bit different than what we've been discussing on prior Market Carvers, not so much looking at major developments happening right this very moment, like we talked about interest rates or anything going on specifically with the market, but looking more at broad principles and really important things that we think you should know about from both a volatility standpoint and markets and stocks as they have drawdowns and long-term growth. And then Zach's going to dive in to a really important topic looking at the concept of compound interest and specifically the impact taxes can have on that. But first, I want to show you a chart, as I often do, but this time looking at two stocks that you're probably pretty familiar with, at least the companies themselves. It's looking at Amazon on the top, and then we have Apple on the bottom. And these charts go quite a ways back, going all the way back to the late 1990s. And the reason I'm sharing this chart is because it's an important reminder that while we often will see market volatility, and sometimes we can get really focused in the short term, seeing what a stock or an index has done in the last couple of days or weeks, or even just the most recent couple of months, and not recognize what's going on in the long term. Why I picked these two stocks is they're two both very profitable companies, two companies everyone's aware of, stocks that have had very good performance. But when we look at how they got the path and the trend that they've had over these last couple of decades, it hasn't been without some bumps along the way. We can see that during the tech wreck in 2000, Amazon actually lost over 90% of its stock value, and it was in a drawdown for just about 10 years. During the financial crisis, it was down 66% during that time. We saw Apple, it fell 60% during the financial crisis. Looking more recently, just during the bear market in 2022, Amazon got cut more than half. Now, this was all occurring while these stocks still were doing very well when you look at the really, really long term. The main point, the main takeaway from this is recognizing it's important to have a good risk management process, because even really good stocks, companies that we think actually have a lot of value, can still experience dramatic volatility. At the same time, remembering that we want to keep a long-term view and not allow short-term volatility to get in the way and get into the process of us recognizing and unlocking value within certain companies and certain investments that we seek out. And so it's good to have those both under control, having good risk management and having a good buy and sell discipline when evaluating the different stocks or different indexes or ETFs or what have you. And so now we're going to shift it over to Zach. He's going to take, again, looking at some tax implications and compound interest and the impact those two have together.
Yeah, we have a really interesting table here. Pretty simple, but really, really powerful. It's going to show us two of the most powerful forces in finance: compound interest and taxes. Both the left and the right column here are doing the exact same thing. They're just taking a dollar and doubling it 20 times over. The difference being that on the left-hand side, the doubling is done tax-free, and the right-hand side is taxed at 25%. The bottom lines there, pretty staggering. Just north of $1 million when doubled tax-free, $72,000, about 15 times smaller when taxed at just 25%. Briefly on compound interest, just want to make the note, both lines, despite the disparity, which is notable, both lines pretty staggering to think that you can double a dollar that many times, just 20 times, and get a number that large. Really speaks to the power of exponential growth, compound interest, and the necessity to be a long-term investor, to ride out market cycles and to really give money the ability to grow over a long period of time. But what we want to focus on today is the impact of taxes. It's hard to ignore how much smaller that right-hand number is compared to the number just north of $1 million on the left, especially at just a 25% tax rate. Our team is very, very tax conscious, both on the investment side, but also on the advisory side. There are tools as portfolio managers that we have to be able to help mitigate some of the tax consequences within your accounts. Some of that being tax loss harvesting. We can direct where we place certain assets inside of particular accounts, specifically if you're invested in some of our Core Plus solutions, being very intentional about placing those in the proper accounts. How much in capital gains we recognize, so on and so forth. We do have some tools on the asset management side, but really want to highlight the work that our advisory team does, Many of you have felt the fruit of their intentionality with tax planning, particularly around this time of year as we near the beginning of Q4. A lot of tax planning starts getting closer to year end, whether it be directing you as to where to contribute money, where to withdraw money in particular seasons of life, down to things like Roth conversions, moving money from taxable accounts into tax-free accounts. Very, very beneficial in the long term, both setting you up well for tax implications today as well as tomorrow. So as we get closer to year end, as I said, getting ready to start Q4, would strongly encourage you to reach out to your advisor, have more conversations about what it looks like to mitigate some of that tax consequence.
All right. Thank you, Zach, so much. And that's what we have for this week's Market Carver. If you have any questions or you'd like to set an appointment, please reach out to us through our website below or call us at 1-800-928-4001 or the QR code that's on your screen. As always, thank you so much for tuning in. We look forward to giving you some more information and sharing with you next week. And as always, that's this week's Market Carver. Thank you.